What are some things that investors can do to future-proof their assets and, maybe be a little bit more prepared for some conversion potential or other opportunities down the line?
So I think that focus on strategy and really being thoughtful about what is the business plan and really being challenged and what could go wrong, that is the single biggest thing that I would say should be part of investors' process.
Let's talk about investing in the future of commercial real estate. We're going all in on resiliency, asset flexibility, and everything else you need when assessing your next office asset. Welcome to another episode of In the Loop. Today, we are joined by Tim Bodner, partner at PwC and U.S. and global real estate deals leader. Welcome, Tim.
Thanks for having me and for us.
Yeah, we're excited to have you.
Thank you.
Today we're going to be talking a lot about, investor decision making, and really just, your bread and butter, which is super exciting. So for those that don't know you, can you start us off with like the ins and outs of your day to day and just kind of what's the day in the life of Tim?
First and foremost, I'm a client service partner by background. So I serve clients that are executing deals. The clients that I cover are private equity firms, sovereign wealth funds, real estate investment trusts, family offices, endowments. So it's a pretty wide group of market participants. And so that's my foremost priority. And then secondarily is I look after and support partners in our teams here in the United States and around the world. So I spend a fair amount of time traveling throughout the U.S. to San Francisco and New York and Chicago and Dallas and Miami and everywhere in between, but I also spend a lot of time globally and internationally too. So we spend a lot of time, I think, in both serving clients and then just staying close to our clients and teams around the world.
Awesome. Very cool. Is there like your favorite part about your job, that the one thing that you really love doing?
Yeah. For me, being in the market with our teams and our clients is first and foremost my favorite thing to do. And I think it's really critical because the markets are moving so fast that to really understand what's happening on the ground, you really need to be close to where the action is. And so I think by being in these places I was just talking about, I'm able to do that.
Oh, yeah. And I know you said you just got back from a big trip, hit some 4 big hitters. What were some of your takeaways from that experience?
Yeah. So my number one takeaway, it's actually interesting because I sent a note to our global team afterwards with my top 10 takeaways. So I'll give you the first 3.
Perfect.
I think number 1 is there's a lot of talk about deglobalization. Just generally from a theme perspective, when you kind of just look at what's coming out in various publications and the like, what I would say is globalization is very much still alive. And in fact, I would argue that capital flows are actually becoming more global in their scope. I mean, the amount of capital investment that's being required in places like the Middle East from around the world is at very high levels. There's still a lot going into Asia. In fact, Asia is one of the most active markets right now for investment within real estate and real assets. And similarly, there's a lot of inbound capital as well. So the globalization of the economy is still very much in line. The second thing is real estate is no longer like the 4 food groups that people historically talked about. So like when I look at, for example, transaction trends, oftentimes what I see volumes of office, retail, multifamily, logistics, things like that. What's happening from an investor perspective is they're being much more broad in their scope. So they're spending a lot of time looking at emerging areas like sports and live entertainment. Certainly here in Washington, D.C., where we are right now, there's a tremendous amount of this activity going on. There's people are looking at semiconductor manufacturing facilities, battery manufacturing facilities, battery storage. Obviously, data centers is still a hot topic. It's debatable. People have different views on where we are on that. But this concept of real estate being those 4 things is gone.
Yeah.
And so it's really more what I like to call real estate and real assets because it includes all these other things. And then the third thing is that for the last 25 or 30 years, most real estate investors focused on what the most optimal cost of financing they can get is and how do they think about what the cap rate's going to be over their hold period. Those days of where that kind of cost of capital and cap rate is kind of gone, and there's a lot more focus on what is the actual business plan, how are we going to drive and create value, and that's happening all over the world.
Wow. What are some of those factors that they're doing, like where that shift has happened from like cap rate and pricing to the value side of it?
Yeah. So, I mean, it's interesting because our business, a big part of our business is due diligence. And oftentimes historically when we did assignments for some of the clients I was talking about, it was very much focused on what is the insurance provider or the financial counterparty going to want. And that was the focus. Now we're spending much more time earlier trying to understand, like, what is the thesis? How do you think about the market? What are the demand drivers? What are the threats? How do you think about investments for resiliency? What kind of risks are coming into those markets? So a lot more on the front end to try to understand, like, what really is going to drive value.
How does location compare to like amenities and experience in that decision making nowadays?
Yeah. So location is always going to be important. And, what we saw during COVID is we saw, people moving out of the cities and into the more of the suburban environments. I would say that that's pretty much reversed itself in the major areas around the United States, for sure. Internationally, it never really changed, to be honest with you. I mean, I remember being in Singapore right after COVID, and they were building 3 new office buildings, like right within downtown Singapore. And so that dynamic of work from home never happened in Asia.
Wow.
And it was much more limited in Europe.
Yeah.
Right. That was mainly a U.S. phenomenon. And so we saw a lot of that happen now. But now we're seeing people go right back into the city. We've seen, brand new office buildings opening up on Park Avenue from a large financial services company. We see a lot of new development happening in Midtown and downtown in New York as well that, certain of the private equity sponsors have built. So location's always going to matter.
Yeah.
The difference is that the leasing activity is much more closely tied to the amenities that are being offered and the experience that's being offered to tenants. And that is a differentiator.
Yeah.
In fact, I was just in New York yesterday. I was meeting with the head of leasing for one of the large private capital managers, and we were having this discussion around how they're thinking about their portfolio and then future development activity. And we were talking about, like, what are the top 2 things impacting leasing decisions. And number 1 was location, number 2 was amenities. And then with amenities, the top 2 amenities are conference space and wellness.
Wow.
And so tenants are really making, and it's not just having like a gym in the basement and the side, it's actually having a proper wellness facility where there's a lot of different offerings.
How has sustainability and resiliency and those kind of new policies that may be coming out and those types of trends impact the investor decision making?
So what I would say on this is, the sustainability conversation, particularly, and it's interesting to have this conversation around the world, because in Europe, the conversation there is very, very different than it is here. I think where the direction of travel is it's less about sustainability and what are the long-term drivers of value creation, which we were talking about earlier. And the reality is that a lot of these sustainability-related initiatives are good for drivers of value. When you think about energy efficiency and things like that those are good drivers of long-term value creation. So that is happening, but it's more through this value creation lens. The resiliency conversation, I think, is quite interesting. We just did a publication on this around investments in resiliency and the corresponding impact on insurance costs. Because what's happening in a lot of cases in some of these cities around the world is that people are not being able to get insurance, or they're not being able to get insurance at rates that they think are palatable. So the insurance industry is trying to push for more investments in resiliency. From a real estate market participant perspective, it's a bit of like a push and pull. Because the question ultimately from an investor perspective is, what's my ROI on that over my hold period? And for the longest time, when we were doing deals with our clients, it was outside of their hold period. It was outside of 10 years. It could be 15, 20. Obviously, there's always things that could happen. But in general, it was kind of like viewed to be a longer term tail risk than something near term. What's really fascinating about what's happening now is that the real estate capital markets are undergoing a structural transformation. So the amount of capital coming from traditional institutions is becoming a smaller proportion of the overall AUM of a lot of these market participants. And there's a lot more money coming from the retail channel, so people like us, and the insurance companies. And we have longer time horizons than an institutional investor because we're most often investing for retirement. So the conversation we're having now is as that hold period lengthens, how do you think about this question of how should you invest in resiliency? And that's, I would say, something that will gain more prominence moving forward, where you start to see more of that being part of the underwriting and focus as part of a diligence process.
Oh, yeah. What do you think were some of the catalysts for that shift?
Well, one catalyst is just the simple fact that, the insurance cost that people are getting is just, it's unsustainable, particularly in certain sectors like multifamily. It's just, you can't have insurance costs go up by 35%. In fact, I was just looking at a not-for-profit here in the Washington area the other day, and their insurance costs just on the real estate here in DC went up over the last 5 years by 50%. That was a not-for-profit, which is really a lot of pressure. So a lot of it's on the insurance side. The second thing I would say is that it's tenants and users are demanding certain things be hardened, because there's oftentimes in some of these cases, particularly within the financial services sector, critical infrastructure. So if you think back to like when Hurricane Sandy hit New York, there was a lot of servers and data centers and other things like on the lower floors of a lot of these buildings that were seriously affected. So a lot of it is being driven by the tenants. And then the third thing I would say is it's just generally viewed as a long-term driver of value creation, in terms of if you're going to at some point exit in 15 years, you need to make sure you get an exit that's accretive to your investors. And so it's kind of that longer-term mindset around how do you exit the investment and what valuation.
We talking a lot about kind of driving that long-term value. At PwC, what is some of the kind of factors that you advise on when making those decisions? I
think what I would say first and foremost is if you start on the revenue side of the ledger and you ask questions historically, who's your customer? Who's actually in your asset? Oftentimes that question couldn't be answered. But it matters because that ultimately impacts the demand and supply characteristics and ultimately the rents you can charge. So now what we spend a lot of time doing is actually saying, okay, you have an office building in Hudson Yards. You think the people that are coming into your asset are these types of people? Is that actually who's in there? Or if you look at who's actually coming into the asset on a regular basis, sometimes, the office utilization statistics would say it's, 50%. But then when you actually kind of get into it and leverage more advanced technologies, it's actually more like 80% in some cases. So on the revenue side, there's much more focus on understanding really what's happening at the asset, and then how can you leverage technology to think about what the rent levels are that you can charge. So that's what's happening on the revenue side. On the expense side, we spent some time talking about sustainability initiatives like energy efficiency and things like that. That's certainly a big area of focus. The other thing that we're spending a lot of time on is what's the right operating model for your asset. A lot of investors historically have been vertically integrated. Some investors still think that's the right answer, but there's a growing share saying, is that really the right answer? And should we maybe outsource some of this to drive, a lower overall expense base and in turn create value?
Yeah. You mentioned that some are kind of still thinking vertically is the way to go. Where is that shift coming from, and why are some people a little resistant to it?
So what's really interesting is that as technology grows in its importance, not just because of AI, but just generally, AI adds to that, but certainly just technology is more important. Those investments are quite capital intensive. So the question is, for some market participants, they just don't have the scale to be able to make those capital investments. So for them, if they think about 5, 10, 15 years out and they're kind of a middle market manager, they're not going to be able to do that. And so they're going to have to do one of two things. They're going to have to partner more with others, or they're going to have to think about becoming part of a larger enterprise, which I mentioned briefly before that, we're in the process of doing our deals outlook for 2026. And one of the things that we're focused on in our global outlook is that we expect significant consolidation within the real estate investment management industry. For private enterprises, we expect that it could be up to 20% of managers that are in place today are part of a larger enterprise over the next 5 years. If you look at public REITs, which in the U.S. we have, give or take, something like 185 public REITs in the market. If you look at of those public REITs, how many of them are actually driving the total shareholder return over the last 10 years? It's less than 50%. So there's a lot of consolidation happening in the investment. We think that's going to, both sides, public companies as well as private companies, will happen because of some of this that we're talking about.
Yeah. As we're looking at some of these differing markets and differing asset classes, what are some indicators or risk models that you recommend as investors evaluate these different assets?
Yeah, so look, I think what we talked about earlier around the resiliency of the assets is going to be increasingly important. And it's not just the resiliency of the asset itself, but it's also the resiliency of the city. And so what are the risks that are being presented by various macro things that could happen around the city itself, and how does that have a kind of a tail effect on the asset level? So it's kind of both, but resiliency for sure is, I think, something that's a priority. Your comment on risk model is actually really interesting, because a lot of these risk models, particularly that are built around insurance type of risks, are not necessarily fully calibrated to what we've seen. So the level of climate-related events, for example, that we've had here in the United States and around the world is, it's happening at a much more accelerated pace than we've ever seen before. And so the models that are underneath that aren't necessarily fully aligned just yet. And so I think there is an evolution that's happening around the models that are being used. And so there is a little bit of a question in investors' minds around, is it really, are the models really set up and give us the right level of detail, or do we have to do other things to think about resiliency? But that would be number one. Number two is asset flexibility. So if you think about a lot of the office space in the United States today, a lot of it was built for a very specific purpose. It was built to be an office building. But what happens as demand patterns change, as tenant behaviors change, as preferences change, how can they be adapted to fit the new normal? So, for example, we may get to it, but if you think about the office to residential conversion topic, that's something that people, I think, would do more of. Yeah. But a lot of these office buildings don't have the floor plates and are not set up in a way to facilitate that. And so I think investors are much more focused today, and we advise them to be much more focused on what happens in 5, 10, 15 years if certain things change to where you need to have different things inside the asset, or maybe you wanted to use it for a different purpose.
Right.
And then the third thing I would say is just around kind of some of the more intangible characteristics of assets, just the size and the level of amenities that are there. DC is kind of an interesting area because of the height restrictions. Every office building is pretty much, from a scale perspective, is pretty close to the same level. But in other places around the world, in cities in the United States, it's different. Yeah. And so do you need as many, 100-story office buildings, or do you need, a building that may be 100 stories, but let's say, 25 floors are office, and then there's maybe 25 floors that are apartments, and then there's like ground floor retail. So this kind of componentization of assets And the characteristics is, I would say, the third thing that we would say and advise people to be focused on.
Wow. Yeah, that's definitely helpful and good actionable insight. In a previous episode, we met with Evan at JBG and talked about national landing. Can you tell me a little bit about that, how that mixed use and adaptive reuse of spaces is becoming more prevalent?
Yeah, for sure. So I mentioned earlier this movement when I was one of my takeaways from going around internationally is a shift from just real estate to real estate and real assets. And what it fundamentally comes down to is the experience that's provided to the residents, and having kind of one ecosystem where people can go to work, they can spend time socially, they can go to the gym, they can do something on the nights and weekends. So if you look at what's happening here in DC, National Landing comes to mind, the Wharf comes to mind, the Navy Yard comes to mind. If you think about, for example, what is happening with other professional sports franchises, both downtown as well as, kind of across the river, all of that is tied to this trend around these mixed-use entertainment districts around creating this overall kind of ecosystem effect around experiences. What's fascinating about this is that this is happening at a scale that we've never seen before, and a big driver of it is around sports and live entertainment. And a lot of sports franchises and live entertainment providers are very focused on how do you take a traditional environment, a venue, that only would be occupied for a season or for a period of time and turn it into an asset that gets attention every day of the year. And there's examples going around this at the professional sports level in places like Atlanta. There's a tremendous amount going on there, but it's not just professional sports. It's also happening in the collegiate level. And so you see a lot of colleges and universities doing the same thing where they're trying to say, okay, we have our campus here. How do we think about the placement of student housing? How do we create incubator hubs for employers to have their office space there? A good example is at National Landing. There's some universities that moved in there, so that's an example of that. So this is something that has a tremendous growth tailwinds behind it. What's interesting that we see from an investor perspective is not all investors want to be part of every piece of that. So oftentimes we see investors may be really interested in the office space, or they may be interested in the retail, or they may be interested in the multifamily component. And so you kind of have this, different investor groups that are part of this kind of capitalizing and bringing this overall project life to fruition. But it's a significant trend, and it's an important one.
Oh, yeah. And that's fascinating that investors are not necessarily wanting to get a piece, like the entire pie. They just want their piece of it. Do you see that trending to a different direction, or do you think that's the way we'll kind of continue with it?
I think it'll be probably a bit of a mix of both, to be honest. I think some investors will just not be comfortable with the total return profile of certain dynamics, so they may only want a piece, and others will take the alternative view. So I think it'll be a mix of both as opposed to one or the other.
As we're kind of talking about future-proofing this and forecasting a little bit, what are some things that investors can do to future-proof their assets and, maybe be a little bit more prepared for some conversion potential or other opportunities down the line?
Yeah, so if you go back to kind of the conversation we were having around cost of capital and cap rates, the focus on the front end around strategy. What's really our strategy? What's our business plan for this asset? How do we think about the downside risks? For example, when I was in New York this week, I was at a conference with the top 150 financial services firms in the world. And one of the questions that was being asked to all these different investors was, what's the impact of AI on our investment strategy, right? And in an office, that's a really important question to ask yourself.
Right.
So I think that focus on strategy and really being thoughtful about what is the business plan, and really being challenged, and what could go wrong, which has always kind of been part of it's always been part of the mindset of investors. But there's so many different things going on right now that there needs to be much more focus on. So I would say that is the single biggest thing that I would say should be part of investors' process.
So what are some things that you see or some mistakes that folks may make as they're trying to assess an asset and kind of decide whether or not this is the right investment for them?
Yeah, thanks for asking that question because it's interesting because, one of the things that we're constantly having discussions with our clients about and market participants is, for a long time, investors were so focused on cap rates, cost of capital, that their mindset is in that area. We need to kind of get the mindset shifted to think about some of these other bigger things that you're asking about. So one of the things that I see, mistakes I think people have the risk of making, I'm not saying they're making it, is not investing enough in upskilling their people to understand really what the long-term drivers of value creation are. And a lot of that is to have a much more of a commercial mindset versus having a financial mindset. And that's just a new muscle for a lot of people. So that's number one. Number two, I would say not spending enough time around what we were talking about a few minutes ago around really what is your strategy? Why are you buying this asset? How really are you going to create value? How is technology going to impact it? What is the AI risk to this? Like all the important things you're asking around and resiliency and sustainability, just how are you thinking about those? The technical details around looking at the historical earnings profile, like that stuff's there's a lot of people generally get that part right. It's more these front end considerations that I would say are what we would like to see people spend more time on, because we do have a concern that things could get missed.
Yeah. Oh yeah. What are some things that, you are always wanting to make sure aren't missed in that process?
Yeah. I think it's the things that we're talking about, which is like, do you really understand what's happening in the asset today? So if it's a multi-family asset, do you really know who your tenancy is? If it's an office building, do you really that has retail and office components to it? Do you really understand who's coming in to that asset? Do you understand what's important? It's a much more of a hospitality mindset that needs to be brought to real estate than we've ever had before. And that, I think, is tied to this discussion we've been having around like people want to have a good experience inside of an asset.
Oh yeah, that's something we talked a lot about in season 1 is kind of the hospitality side of office and even residential now too, is that shift and that change there. How do you think investors, especially in office assets, are adapting to that shift?
I think it's early days. The problem again is that, again, I go back to this conversation I was having yesterday with the head of leasing of this large landlord. I mean, they're going through a comprehensive analysis now of every single asset they have and asking that question you just asked me. And so I think you have people like that are very sophisticated, that have generally newer assets that I would say are on the leading edge of that.
You mentioned the 2026 trends report that was recently put out. In there, you talked a little bit about the fog that's happening within the market.
Yeah.
How would you recommend investors cut through that fog?
Yeah. So I always like to tell myself and try to share with the team is that the real estate industry has adapted to cycles, for forever. And there's been significant things that have happened, right? If you go back to the savings and loan crisis, or you think about COVID, or you think about the financial crisis, real estate investors have always adapted. And so the reason that that's happened is because people have always focused on what they can control and try to just figure out how to minimize what they can't control. And so I think that's how I like to think about the fog, whether it's a clear day or it's a slightly clear day, right? Which is some of what came through in the report. I think it's going to differ by the day, right? We don't really understand, if you just think about what's happening geopolitically, that changes so fast these days. We really don't know. We also don't know what's going to happen from a public policy perspective fully. We don't really understand what's going to happen with interest rates. And even though short-term interest rates keep trending down, long-term rates have not gone down to the same level of magnitude, but they're still at better levels than they were, and they're still not high, but we still can't control any of that. And so focusing on not ignoring those things, but focusing on how do you still run your business in an environment where those unknowns are always going to be there. And that's, I think, what's always amazes me about the real estate industry is it's always found a way to adapt.
Yeah.
Forever.
Yeah.
Right? It's always found a way to adapt. So that's how I would like to think about it.
Well, Tim, can you tell me a little bit about the volume of office investments in today's market?
Yeah. So I would say very much office is back on the table again as an investable asset class. Increasingly, a greater number of market participants are taking the view that we hit the bottom. And if you just think back over the last 90 days, we've already seen them 3 public to private real estate transactions in the office sector. One was a Canadian listed REIT with U.S. assets, and the other 2 were U.S. listed companies with U.S. assets. And so office is definitely part of what's considered investable again. And it's not just private equity type of capital, it's across the board. So we're seeing a lot of focus on the asset class by family offices and the like. So I think we should expect more activity in the market. And to be clear, it's not just in select markets. It's across the board. Even in a place like San Francisco, we've seen a number of deals getting done, and we expect to see more there. So I think that's one thing. The other thing that's really interesting is if you look at the financing markets, and in particular, if you look at the securitization market, so things like the commercial mortgage-backed securities, which is an important part of the financial markets for real estate, the most volume in CMBS outside of data centers is in office.
Wow.
And a lot of it's big marquee assets in New York, but it's a huge part of the financing market. So office is definitely something that I think we should watch carefully.
I want to wrap us up with our favorite question, which is, what is your favorite city and why?
Favorite city is Tokyo.
Okay.
Why? The amount of activity happening in Japan is incredible, with just the amount of new things being created and a number of things to do. The food is phenomenal. The people are great. The proximity to other parts of Asia are great, and it's one of my favorite places to be. Last time I was there was about a year ago, and I only had 1 week, and I probably should have had 3.
There you go.
So that's my number 1 city.
Get it all in there.
Yeah.
If there was one thing you could do to improve Japan, what might it be?
I think it's already kind of happening, to be honest with you. But I think, for a long time, there was a question around whether it was open to foreign capital. I would say that now it's definitely opening up to foreign capital, and there's a lot of activity happening there. So that's what I would say is if we can make that happen with more pace, that's what I would do.
Yeah. Can you tell me a little bit about what that looks like, opening up this, Tokyo to foreign capital?
Sure. For a long time, a lot of these corporate enterprises in Japan they were basically conglomerates. They owned everything. And now what's happening is that they're actually going the other direction. So having that happen with more scale, it will enable more capital to go there.
I love it. Well, that's wonderful. Thank you, Tim, for joining us and for sharing your insight and actionable advice. And thank you, listeners, for joining us on another episode of In the Loop. We'll have plenty more. And thanks for coming.
Thanks for having us. Appreciate
it. We have more new episodes coming on topics like adaptive reuse, tenant retention, and more. Make sure to subscribe so you'll be the first to hear what's coming up for offices in 2026.